Hey traders, Jason here from Levitt Brothers. So I'm going to talk about the current state of the market. I'm going to talk about the S&P, go through some breadth readings. Overall, market's done really well. Okay, off the April low, ran up, huge gains. A lot of stocks popping, breaking out, following through, pausing, following through even more. We've had a lot of runners, a lot of great trades, but the last couple of weeks things have softened. We're not, there are still runners, but not as many. We've had to change our trading style a little bit. Okay, it's one of the keys to trading is you got to make adjustments as the market changes. You got to make some adjustments. Maybe a month ago you're playing breakouts and letting them run. Maybe adding on some size, like shooting for some bigger wins. But nowadays stocks are breaking out, running a little bit, and then falling back. Okay, so whereas a month ago you could use a loose stop and give stocks some time and space to move around. Nowadays you gotta be a little bit quicker to take profits, be a little bit, content with smaller gains. So again, just want to assess the state of things right now, look at the S&P, and then zoom in with some breadth readings to see what's going on beneath the surface. All right. So here's the S&P weekly. Obviously last year trended up, higher highs, higher lows, no big, huge back-to-back weeks, but just steady, 2 steps forward, 1 step back type of price action. The 21 acted as support several times. As we were coming in here, breadth readings fell off pretty quickly. So we got plenty of warnings that a top was going to be in place. We had no idea the market was going to fall this much, but we definitely had warnings that the market was going to drop, and we needed to make some changes. So market plunges, rallies back. And as you can see, we've had back-to-back weeks where the market tested higher here and here. We tested higher, but then closed near its lows. No big deal. I consider this like to be pretty good price action. Okay, the market's not going to just go up and up and up nonstop. I think this isn't a prediction, but if the market came all the way back down to 5,800, which is approximate location of the 21-week moving average, if that happened, to me, the market would still be in good shape. Okay, it happened over here, market recovered. It happened right here. It didn't quite get there over here. It happened over here. Like in an uptrend, you get several up weeks in a row. You get a gap between the price action and the moving average, and then you get, a combination of sideways movement and down movement to allow the moving average to catch up, and then the index could, continue on. So I'm not saying that's going to happen. I'm just saying, like, if we actually got a 150-point drop right here down to 5,800, that would not destroy the overall bullishness of what's going on. Okay, so might have to make some adjustments with your trading style and how you manage positions to account for the possibility of this happening. But overall, even if it happened, I don't think that would, that doesn't mean a top is in place, or in this case, a double top would be in place. All right, let's look at the breadth. So here's S&P 500 versus the 5-day moving average of the NYSE AD line. We could see, higher high over here, lower high over here. I was warning traders at Levitt Brothers, hey, need to be a little bit more careful here. Internally the market is starting to weaken, and what we got here is we got like a 4-day pullback over here. Okay, then the market goes up to a higher high, and then we get another negative divergence that comes in place. And again, I was just telling Levitt Brothers subscribers that, hey, gotta be a little bit more careful here. We can still play longs. You still want to play longs, but you gotta, instead of playing like A trades and B trades and being, I don't want to say irresponsible, but when the market's acting really well, you could push it a little bit. But when the market gets more selective like this, you can't push as hard. So I was telling Levitt Brothers subscribers, be a little bit more careful. Don't let, if you got a good gain, move a stop up, protect it. If you got a little bit of a loss, just take the loss and don't let it grow, because internally the market was weakening. That's what's happened here. Now what we want to see is some sort of recovery. If this stays down here, we're going to get a bigger pullback. Okay, so this is like normal stuff. Market moves up to a higher high. There's a softening of the internals. We know the market's either going to move sideways or down. Now that it has moved sideways for a week and a half, 2 weeks, now we want to see a recovery of the indicator. We'll see if that happens. All right. Backing out a little bit, this is the same idea, but we're using the 10 moving average of the NYSE 80 line, the 20, and the 50. So the same divergence took place with the 10 here. So you can see lower highs when the market was going up. So we were giving ample warnings that, hey, when the market was here and everything was doing great, you could push, you could make a lot of money. You can actually get, be a little bit irresponsible because the market was going to rescue you from managing trades incorrectly. But when we entered this period here with these divergences, we knew that kind of a market was done, and we were going to have to be a little bit more responsible managing positions, keep stops, be a little bit more aggressive with taking profits, not always letting them pull back to a stop. So the 10, obviously a decline. The 50, the 20, same thing, negative decline, just like over here. So we know that internally the market is weakening. The 50 continues to do well because these data points here are replacing data points from over here. So that's why this line has been able to move up pretty well. So long term looks great, but in the near term, we definitely have some warnings that the market's softening, and we just have to make adjustments with our trading. But overall, this is the NYSE 80 line. This is the 80 line. This is the cumulative line, and you can see it broke out of a falling rectangle pattern, pushed higher, came back, tested the 21 here, pushed higher. Now testing the 21. So higher highs, higher lows after breaking out. Long term, the market looks to be in good shape. It's the short term, the 5, the 10, the 20 that have warned us for the last couple of weeks that beneath the surface, support for the market moving up has declined. All right, so here is S&P 500 versus S&P stocks above their 20-day moving average and 50-day moving average. And you can see negative divergence forming as the S&P has pushed to a higher high. Doesn't mean the market has to crash. It just means we have been given ample warning over the last couple weeks that less stocks are participating. Okay, so you have, market is over here at 59.50, and you have 90% of S&P stocks above their 20s. Market pulls back and then rallies up to over 6,000, close to 6,040, and now you only have like 72% of stocks above their 20-day moving average. So we go from 90 to like 71, 72. So a full 20%, almost 20%, but 20% times 500 stocks in the S&P, approximately, there's like 501 or 2. That's almost 100 stocks. There was 100 less stocks above their 20 here than over here. Okay, so that's a little bit of a warning. We got the same warning with the 50s. Doesn't mean the market's going to crash. It just means we need to be a little bit more careful, be more selective, only trade the A+ setups. Don't be careless. In an uptrend, you get pullbacks below 50%. That's perfectly fine. Okay, as long as there's a recovery. So right now, this is, we could recover from this. Okay, but if we get extended time here, where the market struggles to recover, if we get a deeper plunge below 50%, then we're probably going to get a bigger pullback from the price action. All right, here's the same chart, except I'm using the NASDAQ 100 versus the 50 versus the 20, and the NASDAQ 100 versus the 50. I don't need to go into this too much because it's the same divergence that's forming. Okay, market over here at NASDAQ over here at 19,250. And you have a full, you got like 90% of NASDAQ 100 stocks above their 20-day moving average. NASDAQ pulls back and then rallies up here to like 19,700, and now only like 70% of stocks. So again, a lot less stocks participated on this last leg up. At Lever Brothers, I've been warning of this the last 2 weeks. Lever Brothers subscribers have been able to, make adjustments that needed to be made in order to account for this, knowing that the animal spirits were not alive still. But backing up, NASDAQ 100 stocks above their 50s holding good, more than 70%. Okay, so I consider, when you get when the numbers with the 50%, when numbers with the 50-day moving average are still in good shape, but the 20 has declined, to me, this is the overall trend, and this is like weakness, short-term. This is like short-term weakness within a long-term healthy period. So I don't think the market is topping. I just think it's has weakened, and we just need to account for it within our trading. One more chart with this type of analysis. S&P up top, S&P stocks above their 200-day moving average. We got very obvious warnings at the top where market moved a higher high there, but less stocks were above their 200. It was pretty obvious. You can see this circle here that so many less stocks were above their 200 than previously, and now we still have that situation. Okay, so you can see when the market was trending up, it oscillated between 60 and 80%. And now, even though the market has been moving up for 2 months here, the S&P is well above its 200-day moving average. You can see that we have not had great participation. Okay, a lot of stocks lost their 200s here, and then only some of them have been able to recapture it. A lot of them have not. So there's still some long-term internal weakness that needs to be worked out. All right, here is S&P 500 up top versus the 1 month high-low. That's not what I wanted. I got the wrong chart here. Oh, well. Here it is. So here is the S&P 500 versus the 5-day high-low. Okay, and you can see negative divergence forming. Market was moving up here. This was moving down here, and now we have, prints below zero. Okay, so when the market is doing well, like over here, you notice how you get a lot of prints above zero with an occasional dip below, but back here, March, April, when the market was weak, you can see that you get. There are your barriers, minus 2,000, plus 2,000, and there's your zero line. So when the market is starting to weaken, as it was over here, you get these moves below zero. You don't get the big prints anymore, only occasionally. So you can see that, that's a terrible chart. Let me see if I can redraw this really fast, just so it's easier to see. So you can see that with the boundaries there of minus 2,000 to plus 2,000, that's how the market acts when the market is starting to weaken here, okay? Versus when the market is strong, that's what we get, okay? You can see over here we get equal prints above and below, even a lot more below, okay? Even below over here as the market was moving up. But when the market's in good shape, you get a lot more prints above zero with an occasional print below. All right, so if this print just stays down here and can't get back above zero, or it gets above zero but then immediately loses it, then the market's going to go down more. Okay, so we'll see what happens here. Right now, we can, I've been telling Levitt Brothers subscribers the last 2 weeks, market's weakening, be a little bit more careful. And here is the same idea with the 1 month high low. Market pushed higher here, less stocks at a 1 month high low. Market pushes higher here. Couldn't get a high print here, and now we're below zero. Okay, so we need improvement here. Okay, we definitely need improvement. When the market's doing well, you're going to get a lot more prints above zero than below. And, over here, we're at the highs. This high over here was the highest level since, February. So the market's at nearly at a 4 month low, and yet the number of stocks at a 1 month high low was below zero. So more stocks were printing 1 month lows than 1 month highs. Can't last. All right, so overall, market has rallied a lot the last couple of months. We went through a period where trading was really easy. We could push it. We can make a lot of money. But now we're in a period where the market has softened. So best case scenario right now is only trade A-plus trades and manage positions wisely. Worst case is we're actually going to get a mini correction here. Okay, S&P is going to fall at least to 5,800. Maybe a little bit lower. Okay, adjustments need to be made. The way you traded the market 2 months ago is different than the way you trade it now. Okay, that's just the way it is. The market changes. You have to change. If you put your head down and do the same thing over and over, you're going to get run over. You're going to make money at sometimes, but then you're going to give it all back at other times. Okay, make adjustments. Right now, the market's a little bit soft. Who knows? Maybe this lasts for the rest of the summer, and then we get some great runs in the fall. We don't know. Take what the market gives you. Don't be stubborn. All right, we'll see you next time.